One of the most common conversations that we're having these days have to do with home prices. Why? It's very obvious. A year ago, a 30-year mortgage was on 2.75%. It got as high as 6% as of late. It has come down recently. It's pretty obvious what that means. When you have interest rates double, you are taking a huge chunk of money out of the everyday person's cash flow. As an example, let's say you have a $300,000 mortgage. If you're paying make it easy, 3% interest. 3% times that $300,000 is $9,000 a year in interest costs. How much is that per month? About $750 per month. If you make this interest rate just 5%, that takes it to $15,000 a year. You're almost doubling your interest charges. And for somebody buying a $300,000 house or having a $300,000 mortgage, that is a huge chunk of your after-tax dollars. Yes, can you write a chunk of that off? Of course you can. But the point is, this is a huge cost to middle-class America. So, does that mean the following? That we have a bubble that is going to crash and pop and everything's going to plummet? Not necessarily. Are there issues here? Absolutely. But it doesn't mean a bubble has to pop. I am not thoroughly convinced. I've not excluded that we're in a bubble that's going to pop and is going to cause home prices to collapse. But I'm not thoroughly convinced that we're going to see the same type of 2008 collapse in home prices that we saw back then. Now, here is a stat that I want to show you that really drives home the bad news of this entire market. We have to look at the fundamentals of real estate the same way I look at the fundamentals of stocks. So if you're new to this channel, I'm Paul. I'm a value investor. I'm very well known for my stock approach and the way I look at equities in this market. I look at cash flow, and my goal is to buy $1 for less than $1. That's what makes me a value investor. I'm looking for mispricings in the market, and those are driven by the quantitative aspects of the business. So I look at the numbers first, and once I find my group of companies that numbers fit, I weed them out using the qualitative analysis. Now, for real estate, I also look for the quantitative, the numbers that will drive my decisions. So in real estate, one of the most important things I look at the median price of the home to the median income of the area, okay? This is a chart going back to 1955 that shows home price to median household income ratio in the US. This was the housing bubble. We stood at around 7. Today, we're at 8. That's 15% higher than it was during the housing bubble. This is a glaring red flag to me. Now, here's the difference. Let's go back to the 80s. The 80s were at 5, but we had huge inflation here. We didn't have big inflation here. So why does inflation matter? Well, inflation drives up everybody's income and drives up the cost to build. So you can justify much higher numbers. Does that mean that we're going to coast through this thing fine? Not necessarily. But there will definitely be an increase in costs and income that will help support the fundamentals. And as incomes go up, what's going to happen to this ratio? Well, it's home price over income. So as income goes up, the total ratio goes down. As an example, if home price is 10 and income is 2, the ratio is 5. If home price still stays at 10, but the income doubles to 4, your ratio goes down to 2.5. That's the key here. We are looking at the fundamentals of inflation driving up income prices, income values that will drive down the ratio. Is this still an alarming ratio? Absolutely. Guys, we came off of COVID. We thought the world was shutting down completely for a long period of time. And all of a sudden, COVID started to clear up, and all of a sudden, prices of everything skyrocketed. Now, there's a lot of theories behind it. A lot of theories are crypto, and also the whole FOMO, fear of missing out. People wanted to have everything very quickly. I remember hearing stories of, oh my God, your house has been for sale for 2 weeks. How overpriced is it? Like literally, you'd have an open house, and you'd have offers in before the open house was done. That's how crazy it got. People waiving inspections. That is crazy. But one thing I will say, that we don't see here that we saw here, we don't see the absolute fraud in the market. I'm not hearing stories about fast food workers getting approved for $150,000 mortgages on homes that they clearly cannot afford just because they claim to make way more money than they actually do. I'm not hearing that here. I'm just hearing a lot of pent-up demand that's also driven by low interest rates. When interest rates fall in half and fall so much, that means you can buy more house. So when you can buy more house, you're gonna end up paying more and more and more to get that house as the demand has increased and the supply has decreased. But we're already starting to see those things change. My fiance and I, we live in Northeast Ohio, but we also are looking at potentially living in Dallas. So we started looking around at houses. And all of a sudden, the house in Dallas, I'm seeing a lot more prices dropped $100,000. Prices dropped $200,000. All these prices are dropping, and I'm like, whoa, before it was house goes up and it's sold within 13 days. House goes up, sold within 15 days. That's the difference here. This is a big concern of mine. I'm always going to go to the home income ratio. But let's go look at some of the worst ones we have. These are small and mid-sized cities with the highest home price to income ratios. California, 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 Hawaii, California, 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 California. Oh my God, finally the East Coast shows up. California, Utah, California. I mean, guys, California is insane. 16 times ratio. That means if the average income in the area is 100K, the average price of a home is 1.6 million. If you're watching right now and you make 100K, do you feel like you could afford 1.6 million? Of course not. That's an insane number. Now, it's probably driven a lot by very, very high-end houses that are skewing the very big extremes. And these are small and mid-sized cities, so a few houses can really skew that big time. But the point is, you still look at these fundamentals. It's just like with stocks. You can have some high PEs, and some of the stocks can justify it. Why? Because they have very high growth levels that really justify the pricing. But at some point, overall, you have to look at it and say, wait a second. Why, as a market, do we have such a high PE? Why, as an entire country, do we have such a high home price to home median income ratio? It's not sustainable in the long run. So, will there be a housing bubble burst? I don't know. But do I believe we're going to be in a recessionary type of feel for housing? I do. It's going to take a little bit longer for houses to sell. There's going to be less demand in the market. There are going to be much bigger cuts to pricing. I'm hoping that I'm already hearing that home builders are already giving a lot more concessions to houses to get people to buy them. This is very sudden, very quickly. Why? Because they raised rates very quickly. And all indications are that as inflation stays up, they're going to raise rates even more. So you're going to see a bigger downward pressure on pricing. But if inflation continues and costs to build and incomes go up with it, you are going to absolutely see an increase in the values of homes and a decrease in that ratio. So if you like what I'm saying here, please watch the next video where we believe that recessions are the opportunity of a lifetime. And also, please subscribe to our channel. Thank you very much.